There is a single idea that separates the masters of the financial universe from the masses. It is not a complex algorithm nor a secret trading signal whispered in the halls of high finance. It is a profound, yet deceptively simple, recalibration of a single word: risk. For the vast majority of people, risk is the gut-wrenching feeling of watching a stock you own plummet by 10, 20, or even 50%. It is the volatility, the daily chaos of the ticker tape, the sharp, jagged lines on a chart that send a jolt of fear directly into the primal core of the brain. Wall Street, in its infinite wisdom, has codified this feeling. They have given it a name, beta, and built entire cathedrals of financial theory upon its foundation. They have taught generations of investors that risk is the bumpiness of the ride. But this definition, the one that governs the actions of 99% of market participants, is a catastrophic lie. It is a lie that costs fortunes, shatters dreams, and turns potential long-term investors into panicked short-term gamblers. Warren Buffett, the man who built a $100 billion empire from the ashes of a failed textile mill, operates on a different plane of understanding. For him, and for the handful of investors who have truly absorbed his wisdom, volatility is not risk. It is opportunity. The real risk, the only risk that truly matters, is the permanent loss of capital. It is the act of putting $1 into an investment and getting back less than $1, permanently. This single distinction is the genetic code of all great investing. It is the master key that unlocks the ability to remain calm when others are frantic, to be greedy when others are fearful, and to methodically, patiently, build life-altering wealth while the rest of the world is caught in a self-destructive cycle of buying high and selling low. To embrace this mindset is to undergo a financial transformation. It is to move from being a passenger, tossed about by the violent waves of the market, to becoming the captain, using those very same waves to propel your ship towards its destination. It is the final promise of investing mastery, the ability to see the world not as it feels, but as it truly is, and to profit from the difference. Our journey begins with the most fundamental act of intellectual rebellion an investor can commit: the outright rejection of Wall Street's definition of risk. This is not merely a semantic argument. It is a declaration of independence from the emotional herd. It is the construction of a new mental framework, a heresy against the established church of modern finance. To understand the power of this heresy, we must travel back in time, to a moment of crisis and scandal that threatened to bring down one of America's most trusted corporate titans, and which provided a young Warren Buffett with the perfect laboratory to test his radical new definition of risk. The year was 1963. The company was American Express, and the catalyst was a substance as mundane as salad oil. A small, unassuming subsidiary of American Express, a field warehousing division, had made a series of massive loans to a company called Allied Crude Vegetable Oil Refining Corporation, run by a charismatic fraudster named Tino DeAngelis. The loans were secured by what was supposed to be a colossal inventory of salad oil, stored in massive tanks in Bayonne, New Jersey. The problem was, the salad oil wasn't there. Tino DeAngelis had devised an ingenious scheme. He would fill the tanks mostly with water, with only a thin layer of oil floating on top. When inspectors came to check the collateral, they would dip their measuring sticks into the tanks, see the oil, and sign off. For years, DeAngelis built a phantom empire of oil, borrowing hundreds of millions of dollars against non-existent assets. In November of 1963, the house of cards collapsed. The fraud was exposed, Allied Crude Vegetable Oil went bankrupt, and its creditors, including American Express, were left holding the bag. Wall Street reacted with predictable terror. American Express, the bedrock of financial stability, the company whose travelers' checks were considered as good as cash anywhere in the world, was suddenly facing potential liabilities far exceeding its net worth. The stock, which had been a blue-chip darling, plunged nearly 50%. Analysts, traders, and the entire financial media establishment declared that the company was mortally wounded. This, by their definition, was the epitome of risk. The stock was volatile, the headlines were terrifying, and the uncertainty was absolute. The herd, driven by a primal fear of loss, stampeded for the exits. But in Omaha, Nebraska, a 33-year-old Warren Buffett saw something different. He did not see the terrifying headlines. He saw a question that needed answering. He understood that the market was confusing a dramatic, headline-grabbing problem in one small part of the business with a fatal blow to the entire enterprise. He decided to do what almost no one else on Wall Street was doing. He went to find the facts. He began his own scuttlebutt investigation, a process of on-the-ground research to understand the reality of the business, completely divorced from the opinion of the stock market. He went to restaurants and banks. He talked to merchants and travel agents. He stood in line and watched customers transact. He was looking for the answer to a single critical question. Had the salad oil scandal damaged the fundamental earning power of American Express's core businesses, the traveler's checks and the credit card? What he found was that the public had no idea the scandal was even connected to American Express. Merchants still gladly accepted the cards. Customers still bought travelers' checks with unwavering faith. The competitive moat around the core business, its brand and the trust it commanded, was completely intact. The scandal was a massive financial hit, yes, but it was a finite, quantifiable problem. The core franchise, the engine of the company's value, was unharmed. Buffett concluded that the real risk, the risk of a permanent loss of American Express's earning power, was minimal. The market, in its panic, was offering him a chance to buy one of the world's greatest businesses for a price that assumed it was one of the world's worst. He acted decisively. Buffett invested 40% of his partnership's assets, a sum of $13 million, into American Express stock. It was a bet-the-farm decision, an act of supreme confidence that flew in the face of all conventional wisdom. Over the next few years, as the company sorted out its legal issues and the market realized the core business was a money-gushing machine, the stock roared back. Buffett's investment turned into a massive profit, cementing his reputation and providing the capital that would form the bedrock of Berkshire Hathaway. This was not a lucky gamble. It was the methodical application of a superior definition of risk. He understood that the wild price fluctuation was not the danger. It was a symptom of the market's misunderstanding, an opportunity to be exploited. The true danger would have been to believe the market's verdict without question and sell a wonderful business at a foolish price. This story reveals a deep truth about our own minds. Why do we, as human beings, so readily accept Wall Street's flawed definition of risk? The answer lies in the field of behavioral finance, specifically in a groundbreaking concept known as prospect theory, developed by psychologists Daniel Kahneman and Amos Tversky. Their Nobel Prize-winning work demonstrated a powerful and irrational quirk in human cognition: loss aversion. Simply put, the pain of losing $1 is roughly twice as powerful as the pleasure of gaining $1. Think about that. A 10% drop in your portfolio inflicts twice the emotional damage as a 10% gain delivers in satisfaction. This is a survival mechanism honed over millennia. For our ancestors on the savannah, missing out on a potential meal was a disappointment. Becoming a meal for a predator was a catastrophe. Our brains are hardwired to prioritize threat avoidance over opportunity seeking. The stock market ticker is a modern-day predator, flashing red numbers that trigger this ancient primal fear. When we see a stock we own go down, our loss aversion circuitry lights up. The emotional part of our brain, the amygdala, screams danger and floods our system with cortisol and adrenaline. The rational part of our brain, the prefrontal cortex, is hijacked. We aren't thinking, we are feeling. And what we are feeling is the intense, visceral pain of loss. Volatility, the daily up and down movement of prices, is a constant, direct stimulus to this loss aversion system. It's why we check our portfolios obsessively when the market is down, but only glance at them when it's up. The pain of the dips is far more motivating than the pleasure of the rises. Wall Street's entire business model is built on exploiting this psychological flaw. They define risk as volatility because that's what their customers feel. They sell complex financial products designed to manage or reduce volatility, charging hefty fees in the process. They encourage frequent trading based on short-term market movements, because activity generates commissions. Buffett's redefinition of risk is a conscious and deliberate rebellion against this hard wiring. By focusing on the permanent loss of capital, he shifts the analysis from the emotional, reactive part of the brain to the logical, analytical part. The question is no longer how do I feel about the stock price today, but has the long-term earning power of the underlying business been permanently impaired? This question cannot be answered by looking at a stock chart. It can only be answered by reading financial statements, studying the industry, and understanding the company's competitive position, activities of the rational mind. He has created a mental buffer, a firewall that protects his decision-making from the emotional contagion of loss aversion. So how can we, as retail investors and entrepreneurs, build this same firewall? How do we translate this profound theory into a practical, repeatable process? The key is to create a tool that forces us to be rational when our emotions are screaming at us to be otherwise. We can call it the Risk Recalibration Journal. This is not a gimmick. It is a structured mental model designed to short-circuit panic and enforce disciplined thinking. Here is the blueprint for creating and using your own journal. Step 1. Before you buy a single share of any company, take out a physical notebook or open a new digital document. For each company you intend to own, create a dedicated page. At the top, write the company's name and the date you are doing the analysis. Step 2. On that page, you must write down in clear and simple language the 3 to 5 core reasons you are buying this business. These cannot be stock-related reasons like the chart looks good or an analyst upgraded it. They must be fundamental business reasons. For example, the company has a dominant brand that allows it to charge premium prices, or it has a network effect that makes it stronger as it grows, or it is the lowest cost producer in its industry. This section is your thesis. It is the foundation of your entire investment. Step 3. Based on your research, write down a conservative estimate of the company's intrinsic value per share. You don't need a complex discounted cash flow model to do this. You can use a simple multiple of earnings or cash flow that you believe is reasonable for a business of its quality. The key is to write down a specific number. This number is your anchor of rationality. Step 4, and this is the most critical part of the exercise. You must define in advance what a permanent capital loss event would look like for this specific company. Think like a pre-mortem analyst. What could kill this business or permanently cripple its earning power? Be specific. For instance, for a pharmaceutical company, it might be the FDA fails to approve its flagship drug in Phase 3 trials. For a software company, it might be a major competitor releases a technologically superior product that is 50% cheaper. For a consumer brand, it might be a massive product recall or safety scandal permanently tarnishes the brand's reputation. List 2 or 3 of these potential business-destroying events. Now your journal is complete. You make your investment. And then, inevitably, the market does what it does. Volatility strikes. Your stock drops 10, 15, 20%. The headlines are negative. Your gut is screaming at you to sell, to stop the pain, to escape the danger. This is the moment of truth. But instead of logging into your brokerage account in a panic, you are required to first open your risk recalibration journal. You turn to the page for that company. You reread your original investment thesis. You look at your intrinsic value estimate. Then you ask the final, decisive question. Has one of the permanent capital loss events that I defined actually occurred? Is the reason the stock is down because the business has been fundamentally and permanently broken? Or is it down because of a general market panic, an earnings report that was slightly below expectations, or some other transient fear? 99 times out of 100, the answer will be no. The business is fine. The stock price is just having a temporary seizure. This simple, methodical process forces you to confront the gap between price and reality. It substitutes your pre-committed logic for your in-the-moment emotion. It transforms you from a victim of volatility into an arbiter of risk, allowing you to see the drop not as a threat, but as a potential opportunity to buy more of a great business at an even better price. This is the first and most critical step in applying a wealth-building mindset to your portfolio management. To truly appreciate the power of this framework, we must examine its opposite. We must walk the path of the 99% and understand the flawed logic that governs their decisions. Their world is dominated by a single, seductive metric: beta. In academic finance, beta is the measure of a stock's volatility in relation to the overall market. A stock with a beta of 1.0 moves in line with the market. A beta of 2.0 means it's twice as volatile. A beta of 0.5 means it's half as volatile. For decades, business schools and Wall Street firms have taught that beta is synonymous with risk. High beta equals high risk. Low beta equals low risk. This seemingly sophisticated concept is, for a true value investor, utterly bogus. It is a dangerous oversimplification that leads to disastrous financial conclusions. Consider the dot-com bubble of the late 1990s. Companies with no profits, no realistic business plans, and astronomical valuations were soaring. Many of them, for a time, had relatively low betas because they only went up, moving in a steady, non-volatile climb. According to the academic definition, these were low-risk stocks. An investor buying Pets.com at its peak was, by the numbers, taking on less risk than someone buying a solid, profitable but more volatile industrial company. We know how that story ended. When the bubble burst, those low-risk dot-com stocks became instruments of near-total, permanent capital loss. The low volatility was a feature of the bubble, not a measure of the underlying business risk, which was, in fact, infinite. Now consider the flip side. Imagine a solid, cyclical company, like a high-quality steel manufacturer. At the bottom of an economic cycle, its earnings are depressed, its future looks uncertain, and its stock price is highly volatile, swinging wildly with every new piece of economic data. It has a very high beta. Wall Street would label this a high-risk stock. But a Buffett-style investor who has studied the balance sheet, understands the industry cycle, and buys the stock for a fraction of its replacement cost and normal earning power is taking on very little real risk. The volatility is a sideshow. The low purchase price provides a massive margin of safety. The risk of permanent capital loss is minimal. The path of the 99% is to build a portfolio designed to minimize volatility. They diversify across dozens or even hundreds of stocks, ensuring that no single position can move their portfolio too much on any given day. This approach, known as modern portfolio theory, is engineered to soothe the frayed nerves of loss-averse investors. It's designed to make the ride as smooth as possible. But in its obsession with smoothing the ride, it often sacrifices the destination. It leads to buying high-priced, safe stocks that have very little upside, and, as we saw with the Nifty 50 stocks of the 1970s, can still lead to devastating losses if their growth stories falter. It is a strategy of confident mediocrity, a path designed to avoid tracking error, not to maximize long-term wealth. The direct financial connection between Buffett's definition of risk and superior returns is profound and mathematical. It fundamentally alters the goal of portfolio management. Instead of diversifying to reduce volatility, the goal becomes concentrating in your best ideas to maximize long-term, tax-efficient returns. When you are certain that the risk of permanent loss in a given investment is vanishingly small, it makes no sense to put only 1 or 2% of your capital into it. It makes sense, as Buffett did with American Express, to bet big. This approach leads to a portfolio that looks very different from the typical mutual fund. It will be more concentrated, more volatile in the short term, and infinitely more powerful in the long term. Let's quantify this. Imagine two investors, Investor A and Investor B, each starting with $100,000 over a 20-year period. Investor A follows the path of the 99%. Their goal is risk management via volatility reduction. They build a widely diversified portfolio of 200 stocks, designed to mimic the market with slightly less beta. They earn, after fees, a respectable 7% per year. Their ride is relatively smooth. After 20 years, their initial $100,000 has grown to approximately $387,000. Not bad. Now consider investor B. They have adopted the Buffett mindset. Their goal is risk management via the avoidance of permanent capital loss. They spend their time looking for a handful of truly wonderful businesses that they can understand and buy at a significant discount to their intrinsic value. Over 20 years, they only find 10 such opportunities. Their portfolio is highly concentrated. When the market panics, their portfolio drops significantly because their few holdings get dragged down with everything else. Their volatility, their beta, is much higher than investor A's. However, because they are buying great businesses at bargain prices, their long-term rate of return is much higher, let's say 15% per year. After 20 years of this more volatile but fundamentally less risky strategy, their initial $100,000 has grown to over $1.6 million. That's more than 4 times the result of this safer approach. The difference is the definition of risk. Investor A avoided the temporary pain of volatility and paid for it with a vastly smaller fortune. Investor B endured the short-term emotional pain of volatility, recognizing it as noise, and was rewarded with true financial freedom. This is the mathematical payoff of the Oracle's heresy. It is the core principle that underpins any serious wealth-building mindset, and is as relevant for entrepreneurs evaluating projects as it is for retail investors picking stocks. Once you have fundamentally redefined risk, you are prepared to grasp the second great pillar of value investing, the critical separation of price from value. Most people believe these two things are one and the same. The price of a stock, as quoted on the screen, is its value. If the price goes down, the value has gone down. This is the most common and costly mistake in all of finance. The truth is that price is what you pay, and value is what you get. They are often, and sometimes wildly, different. To internalize this concept, Warren Buffett's teacher, Benjamin Graham, created one of the most powerful allegories in the history of financial education, the story of Mr. Market. Imagine that you are a part owner in a private business. You have a partner named Mr. Market. The problem is, your partner is a manic depressive. Some days, he shows up at your door euphoric, convinced that your business is the greatest enterprise in human history. On those days, he offers to buy your stake from you at a ridiculously high price. Other days, he appears in a state of deep despair, wringing his hands and certain that your business and the world itself is doomed. On those days, he offers to sell you his stake for pennies on the dollar. Mr. Market is a fixture in your life. Every single day, without fail, he is there to quote you a price. But here is the crucial part. You are under no obligation to trade with him. You can ignore him completely. His mood swings, his euphoria, his panic, they have absolutely no bearing on the actual underlying performance of your business. The factory is still producing widgets, the customers are still buying your product, the cash is still flowing into the bank account. Mr. Market's price is just an opinion, and a highly unstable one at that. His purpose is not to inform you of the value of your business. His purpose is to serve you. You are free to take advantage of his foolishness, to sell to him when he is ecstatic and buy from him when he is suicidal, or to simply shut the door and let him rant on the porch. The stock market is Mr. Market. The daily ticker tape is nothing more than this manic depressive partner whispering, or often screaming, prices at you. Confusing his daily quotes with the true value of the businesses you own is the cardinal sin of investing. It is to let the ravings of a lunatic dictate your financial future. A perfect illustration of Buffett's mastery of this principle is his investment in the Washington Post Company in 1973. At the time, the stock market was in a deep funk. The Nifty 50 bubble had popped, the economy was struggling, and pessimism was rampant. Mr. Market was in one of his deepest depressions. The Washington Post was a phenomenal business. It owned the dominant newspaper in the nation's capital, Newsweek magazine, several television stations, and other valuable assets. It was a media empire with a powerful, unassailable competitive moat. Yet, in the throes of its despair, the market was valuing the entire public company at just $80 million. This price was not just cheap, it was absurd. Buffett, doing his homework, realized that the television stations alone, if sold off, were likely worth more than the entire $80 million market capitalization. In essence, an investor buying the stock at that price was getting the Pulitzer Prize-winning Washington Post newspaper and Newsweek magazine for free. The market, in its panic, was only looking at the price on the ticker. It saw a falling number and assumed a failing business. Buffett, in contrast, completely ignored the quote and focused on the value. He knew the business was not worth $80 million, it was worth hundreds of millions. The price was simply a temporary manifestation of Mr. Market's bleak mood. He began buying shares aggressively. He flew to Washington to meet with Katharine Graham, the company's formidable leader, to assure her of his long-term intentions. He was not a trader, he was becoming a part owner. Over the next decade and beyond, Buffett's $10 million investment in the Washington Post Company grew to be worth over $1 billion, a 100-fold return. This legendary success was not born from a complex financial model. It was born from the simple yet profound ability to see that Mr. Market's price of $80 million was a fantasy, and the underlying value of the business was the reality. He let the moody ramblings of his partner serve him, rather than dictate to him. The reason most of us fail to make this crucial separation is due to another set of powerful cognitive biases, the anchoring bias and the herd bias. The anchoring bias is our tendency to rely too heavily on the first piece of information offered when making decisions. In investing, the most recent stock price is a powerful and ever-present anchor. If a stock was $100 yesterday, that number is now anchored in our mind as its correct price. If it drops to $90 today, we don't see it as a potentially cheaper opportunity. We perceive it as a $10 loss from the anchor point. Our brain automatically frames it as a negative event. This initial negative framing then triggers the herd bias. We see the price dropping and assume that other people, the herd, must know something we don't. They are selling for a reason, right? They must be smarter, faster, or better informed. The social proof is overwhelming. The falling price is evidence that the crowd is moving away from this stock, and our deeply ingrained instinct is to move with the crowd for safety. This creates a dangerous feedback loop. The initial price drop, the anchor, causes some people to sell. This selling pressure pushes the price down further, which is then seen by more people as evidence that the herd is selling, causing them to sell as well. This is the anatomy of a panic. It has little to do with the fundamental value of the business and everything to do with investor psychology. Mr. Market's depression is contagious. The mental model of Mr. Market is a direct antidote to these biases. By personifying the market as an unstable individual, it helps you detach emotionally from his quotes. It breaks the anchor. The price is no longer a piece of objective data. It's the subjective opinion of a crazy person. It also helps you resist the herd. Instead of thinking, everyone is selling, I should too, you think Mr. Market and his friends are in a panic today? I wonder if they're offering me any bargains. It reframes the entire dynamic from one of fear and social pressure to one of detached, opportunistic analysis. It's one of the most vital tools for anyone serious about long-term investing. To truly put this into practice, you can use a simple but powerful mental exercise, the Mr. Market visualization. It's a blueprint for turning the daily noise of the market into a strategic advantage. Step 1. Actively personify the market. Give him a name, a face, a personality. Maybe he's a frantic, sweaty man in a wrinkled suit, or a moody teenager who alternates between irrational exuberance and bottomless despair. The more vivid the personification, the better. This act of imagination is the first step in creating emotional distance. Step 2. Each morning, as part of your routine, visualize Mr. Market knocking on your door. He's holding a clipboard with a list of all your stocks. He makes you an offer. He'll either buy every share you own at his quoted price, or he'll sell you his shares at that same price. No negotiation. Take it or leave it. Step 3. Your task is to calmly listen to his offer and then, in your mind, say one of 3 things. The first is, "No thank you, Mr. Market. Your price today is not interesting to me. The value of my business is much higher than your panicked offer to buy, and your price is still too high for me to buy your shares. I'll see you tomorrow." This will be your response most of the time. The second is, "You know what, Mr. Market? You seem terribly depressed today. You're offering to sell me your stake in this wonderful business for a price that is just foolishly low. I'll gladly take you up on that offer. This is your call to buy." The third, which is far rarer, is, "My goodness, Mr. Market, you are in a state of wild euphoria. The price you are offering to buy my shares at is far beyond what I believe the business could ever be worth. It would be irresponsible of me not to accept. Sold." This is your call to sell. Step 4. After this mental exercise, you can look at the actual stock market. But now, you're not seeing objective truth. You're seeing the recorded ramblings of your bipolar partner. The ticker is no longer a report card on your intelligence. It is a list of opportunities to be either seized or ignored. This exercise, practiced daily, retrains your brain. It replaces the instinctive, emotional reaction to price movements with a deliberate, business-like decision process. It is a core discipline of behavioral finance that separates the amateur from the professional. The antithesis of this disciplined separation of price and value is the world of technical analysis, or as its critics would call it, reading the tea leaves of the stock chart. The technical analyst, or the day trader, believes that all the information they need to make a decision is contained within the price chart itself. They are not concerned with a company's earnings, its debt, its management, or its competitive advantages. They are concerned with patterns in the price history. They see head and shoulders formations, golden crosses, and death crosses. They analyze moving averages and relative strength indices. In essence, they have made the ultimate conflation of price and value. They believe the price adds the value, and that its past movements can predict its future movements. This is the polar opposite of the Buffett mindset. The technical analyst is dedicating all of their intellectual energy to deciphering the manic depressive babbling of Mr. Market. They are treating his moods not as a source of opportunity, but as a source of wisdom. This approach inevitably leads to a hyperactive, high-turnover style of investing. Decisions are made in minutes or hours, not years. The focus is on predicting the short-term psychology of the crowd, not on assessing the long-term economics of a business. This is an incredibly difficult, if not impossible, game to win. It incurs massive transaction costs from frequent trading. It generates tax inefficiencies by realizing short-term capital gains. And most importantly, it chains the investor to the emotional roller coaster of the market, ensuring that they are maximally exposed to the psychological biases of anchoring and herding. They are not using Mr. Market. They are being used by him. It is a path that, for the vast majority of people who attempt it, leads not to wealth, but to the steady erosion of capital. The direct financial benefit of rigorously separating price from value is one of the most powerful mechanisms for wealth creation, the ability to strategically lower your average cost basis. For the investor who confuses price with value, a significant drop in a stock's price is a catastrophe. For the investor who understands the difference, it is a gift. Let's use a simple, concrete example to illustrate the financial chasm between these two mindsets. Investor A, the price is value thinker, buys 100 shares of a great company at $100 per share for a total investment of $10,000. The stock then gets caught in a market downdraft, and the price falls to $50 per share. The value of investor A's position is now $5,000. Anchored to the $100 purchase price and seeing a sea of red, investor A panics. The herd is selling, and their loss aversion is overwhelming. They sell all their shares at $50, locking in a permanent capital loss of $5,000. Now consider investor B, the Mr. Market thinker. They also buy 100 shares at $100 per share. They have done their homework and believe the intrinsic value of the business is actually $150 per share. When the stock price drops to $50, they consult their research. Has the business been fundamentally impaired? No, it's just Mr. Market in a deep funk. So what do? They see a sale. They buy another 100 shares at $50 per share for an additional investment of $5,000. Now look at their new position. They own 200 shares, for which they have paid a total of $15,000. Their average cost per share is now $75. The market eventually recovers its sanity, and the stock price returns to its intrinsic value of $150 per share. Investor A is on the sidelines, having realized a $5,000 loss, and now faces the difficult decision of when to get back in, likely at a much higher price. Investor B's position of 200 shares is now worth $30,000. Their $15,000 investment has doubled. They have a $15,000 profit. This is not a clever trading trick. This is the direct, mathematical consequence of a superior mental model. The ability to view price volatility not as a threat, but as an opportunity to acquire more of a great business's future earning power at a discounted price, is a cornerstone of effective portfolio management and a key secret to buying low and, eventually, selling high. Having redefined risk and learned to separate price from value, we arrive at the third pillar, which is the practical operational tool that brings these concepts to life: the margin of safety. This principle, which Buffett calls the three most important words in investing, is the bridge between theory and practice. It is the engineering that goes into building your financial fortress, ensuring that it can withstand the inevitable storms of market volatility and the fallibility of your own judgment. The concept is simple: never overpay for an investment, no matter how wonderful the business. Insist on buying at a price that is significantly below your conservative estimate of its intrinsic value. This discount, this gap between the price you pay and the value you get, is your margin of safety. It is your protection against bad luck, bad timing, errors in judgment, and the unpredictable turmoil of the economic world. It is the single greatest defense against the permanent loss of capital. A wonderful case study in the application of the margin of safety principle is Buffett and Munger's purchase of See's Candies in 1972. This was a pivotal investment for Berkshire Hathaway because it marked a shift in their strategy. Previously, they had focused on buying statistically cheap, often mediocre businesses, what Buffett called cigar butts, companies that had one last good puff left in them. See's Candies was different. It was a wonderful business with a powerful brand, loyal customers, and excellent economics. The challenge was that wonderful businesses rarely sell for cigar butt prices. The sellers, the See family, were asking for $30 million. Buffett and Munger calculated that the business was earning about $2 million a year after taxes. This meant the asking price was 15 times earnings, which was far higher than they were used to paying. Their initial instinct was to walk away. The price seemed too high. However, Charlie Munger pushed Buffett to think differently. He argued that a great business like See's, with its pricing power and ability to grow without requiring much additional capital, was worth a premium price. They went back and sharpened their pencils. They thought deeply about the company's durable competitive advantage. The brand was so strong in the minds of its customers on the West Coast that it was almost a religion. This brand power gave it the ability to raise prices every year without losing customers, meaning its earnings were likely to grow consistently over time. They reevaluated its intrinsic value, considering not just its current earnings but its future earning power. They concluded that the business was indeed worth more than their initial assessment. But even after recognizing its quality, they did not abandon the principle of margin of safety. They made a final offer of $25 million. This price was not dirt cheap, but it was, in their judgment, comfortably below what the business was truly worth. It gave them a buffer. If a recession hit, if a new competitor emerged, if they had been slightly too optimistic in their projections, the $25 million purchase price still provided a cushion against permanent loss. The See family accepted. That $25 million investment has since generated over $2 billion in earnings for Berkshire Hathaway, without requiring much in the way of new capital. It was a home run investment made possible by their willingness to pay a fair price for a wonderful business, but a fair price that still incorporated a crucial margin of safety. It gave them the confidence to act, knowing they had built-in protection against the unknown. The psychological reason the margin of safety is so essential is that it serves as a powerful antidote to two of the most pervasive human cognitive biases, the overconfidence bias and the planning fallacy. The overconfidence bias is our natural tendency to be more confident in our own abilities and judgments than we should be. We believe we are better than average drivers, have better than average ideas, and are better than average at forecasting the future. In investing, this manifests as an investor becoming enamored with a company and its story, leading them to create a financial model that projects unrealistically high growth rates far into the future. They fall in love with their own analysis and believe it to be fact. Closely related is the planning fallacy, our tendency to systematically underestimate the time, costs, and risks of future actions while simultaneously overestimating the benefits. We assume projects will go smoothly, that competition won't emerge, and that the economy will cooperate. We plan for the best-case scenario because it's the most pleasant one to imagine. The margin of safety is a direct, calculated assault on these biases. It is an act of institutionalized humility. When you demand to buy a stock for 50 cents when you think it's worth $1, you are explicitly acknowledging that your $1 valuation might be wrong. You are building a buffer for error. You are admitting, up front, that the future is uncertain and that your forecasts are, at best, educated guesses. You are creating a structure that allows you to be right in a general sense, even if you are wrong in the specific details. It protects you from your own innate and often subconscious arrogance. It is a tool of behavioral finance that forces you to be disciplined, to replace optimistic storytelling with pessimistic arithmetic. By insisting on a margin of safety, you are ensuring that your portfolio's success does not depend on a perfect execution of your forecast. So how can an individual investor systematically apply this principle? The answer lies in creating a simple, structured valuation framework. We can call it the three-tier valuation model. This is a practical blueprint for building a margin of safety into every investment decision. It's not about finding a single, precise number, but about understanding a probable range of outcomes. Step 1. The conservative valuation. This is your worst-case scenario. Go through your analysis of a company and deliberately use pessimistic assumptions. Assume lower future growth rates. Assume profit margins shrink. Assume the competition gets tougher. Calculate the company's intrinsic value per share based on this gloomy outlook. This number is your floor. It's the value you believe the business would have even if things go badly. Step 2. The realistic valuation. This is your base case or most likely scenario. Use the assumptions that you believe are the most probable. This is your best, most honest guess at the company's future. This will result in a higher intrinsic value per share than your conservative case. Step 3. The optimistic valuation. This is your best case scenario. Assume everything goes right. The new product is a smash hit. The expansion into a new market is wildly successful, and profit margins expand. This will produce the highest intrinsic value number. Now you have a range of values, from worst case to best case. The fourth and final step is the rule of action. Your purchase price must be significantly below your conservative, worst case valuation. If your pessimistic analysis says the stock is worth at least $80 per share, you should only be interested in buying it at $60 or $50 or less. By following this rule, you are building in a multi-layered margin of safety. You are ensuring that even if your worst-case scenario comes to pass, you still have a high probability of not suffering a permanent capital loss. And if the realistic or optimistic scenarios play out, your returns will be extraordinary. This framework turns the emotional process of buying a stock into a disciplined, risk-averse procedure. It's a cornerstone of professional risk management. The path of the 99% is, once again, the polar opposite. They are guided by a seductive and dangerous philosophy: growth at any price. This mindset takes hold during bull markets when optimism is high and stories are more compelling than numbers. Investors identify a group of companies that are perceived to be unstoppable, often in a hot sector like technology or healthcare. They fall in love with the growth story and become convinced that the future is so bright that no price is too high to pay. The Nifty 50 stocks in the early 1970s are the classic example. Companies like Coca-Cola, IBM, and Xerox were seen as one-decision stocks. You just bought them and never had to sell. They were fantastic businesses, and their earnings were growing rapidly. The problem was that investors, caught in the euphoria, bid their stock prices up to 50, 60, or even 80 times their annual earnings. They paid prices that left absolutely no margin of safety. They were pricing in decades of perfect, uninterrupted growth. When that growth inevitably slowed, even slightly, due to a recession or increased competition, the story broke and the stocks collapsed. An investor who bought Avon at its peak in 1973 saw the stock fall by nearly 90% and had to wait over a decade just to get back to even. The same story played out in 1999 with the dot-com bubble. Cisco Systems was a real, highly profitable company, but its stock was bid up to a price that implicitly valued it as being worth more than the entire telecommunications infrastructure of the planet. There was no margin of safety. When the bubble burst, the stock cratered, and investors who bought at the top suffered a catastrophic, near-permanent loss of capital, even though the business itself survived and continued to be profitable. The lesson is brutally clear. It is entirely possible to buy a wonderful company and have a terrible investment outcome if you overpay. The absence of a margin of safety is the surest way to risk permanent capital loss, no matter the quality of the underlying business. This is a crucial piece of financial education for entrepreneurs as well, who can get caught up in growth projections without building in a buffer for setbacks. The direct financial result of always demanding a margin of safety is the creation of asymmetric risk/reward profiles. This is the holy grail of sophisticated investing. It means structuring your investments so that the potential upside is many times greater than the potential downside. Let's quantify this powerful concept. Suppose a stock is trading at $50 per share. You have done your three-tier valuation. Your conservative worst-case valuation is $80. Your realistic valuation is $100. And your optimistic valuation is $120. Because you are buying at $50, well below your worst-case scenario, you have a massive margin of safety. Now let's analyze the risk and reward. What is your potential downside? Theoretically, the stock could go to zero, so your downside is $50 per share. However, because the business has real assets and earning power worth at least $80, the probability of it going much lower than $50 is very small. The business fundamentals act as a floor, providing support for the price. Your realistic downside might only be $10 or $15 to a price of $35 or $40 in a severe panic. Now, what is your potential upside? Your realistic target is $100 per share. That's a $50 gain on a $50 investment, a 100% return. Your optimistic target is $120, a $70 gain, or a 140% return. So you are risking perhaps $15 per share to realistically make $50. The potential reward is more than 3 times the realistic risk. This is a powerfully asymmetric bet. It's the proverbial heads I win, tails I don't lose much. Over time, making a series of investments with this skewed risk/reward profile is a virtual guarantee of long-term success. You don't need to be right every time. You just need your winners to be much bigger than your losers. The margin of safety is the tool that systematically produces this asymmetry, transforming investing from a speculative gamble into a disciplined, wealth-building enterprise. With a new definition of risk, a commitment to separating price from value, and a fortress built with a margin of safety, you are now prepared for the fourth pillar, the courage to be greedy when others are fearful. This is the offensive component of the Buffett mindset. The first three pillars are primarily defensive. They are about preventing catastrophic error. This pillar is about using the errors of others to generate extraordinary returns. It is about transforming a market crash from something to be feared into something to be eagerly anticipated. Volatility ceases to be a threat and becomes the raw material from which fortunes are made. There is no greater example of this principle in action than Warren Buffett's conduct during the 2008 financial crisis. It was a moment of absolute global panic. The world's financial system, built on a mountain of subprime debt, was collapsing. Lehman Brothers had failed. AIG, the world's largest insurer, had been bailed out. The stock market was in a free fall. Fear was palpable. The credit markets were frozen. The prevailing narrative was that we were on the brink of a second Great Depression. Mr. Market was not just depressed. He was catatonic with terror. During this period of maximum pessimism, Warren Buffett did two remarkable things. First, on October 16, 2008, with the market in chaos, he published an op-ed in the New York Times titled, "Buy American I Am." He laid out a simple case. The American economy would, over time, recover and prosper. He stated that if you wait for the robins, spring will be over. In other words, if you wait for good news and certainty, the great buying opportunities will have vanished. He was publicly signaling his intention to be greedy while others were consumed by fear. But he didn't just talk, he acted. He deployed billions of Berkshire Hathaway's dollars, not into the market in general, but into specific, high-quality institutions that needed capital and confidence. He invested $5 billion in Goldman Sachs, the premier investment bank, in the form of preferred stock that paid a 10% annual dividend. He also received warrants that allowed him to buy Goldman common stock at a very low price in the future. He made a similar deal with General Electric. A few years later, as the crisis deepened for the banking sector, he invested $5 billion in Bank of America on even more favorable terms. These were not stock market investments in the traditional sense. Buffett was acting as a lender of last resort, providing a seal of approval that no government entity could. He was supplying confidence to the system when it was most scarce. Why could he do this when everyone else was paralyzed with fear? Because his mental framework was different. He was not focused on the volatility or the terrifying headlines. He was focused on the risk of permanent capital loss. He analyzed Goldman Sachs and concluded that, with the implicit backing of the U.S. government, the risk of it going to zero was minimal. He was being offered a 10% return on his money, plus massive upside from the warrants, to take on what he assessed to be a very low level of fundamental risk. The market was pricing in Armageddon. Buffett was pricing in survival and eventual recovery. The deals were fantastically profitable for Berkshire. The Goldman Sachs investment alone netted more than $3 billion in profit. He was able to act with such courage and decisiveness because he had spent a lifetime preparing. He had the cash ready. He had the mental framework in place. He saw the market crash not as a disaster, but as the sale of a lifetime. The psychological forces at play during a market crash are immense, and they work to prevent rational action. The two most powerful are the availability cascade and the affect heuristic. An availability cascade is a self-reinforcing process of collective belief formation. A story or idea starts to spread, and the more it is repeated in the media and in public discourse, the more plausible and true it becomes in our minds. During the 2008 crisis, the story was financial collapse. Every newspaper, every cable news channel, every website was filled with stories of bank failures, foreclosures, and economic ruin. This constant bombardment makes the negative outcome seem not just possible, but inevitable. Our brains mistake the availability of the story for the probability of the event. This cascade is amplified by the affect heuristic, which is a mental shortcut where we make decisions based on our current emotional state. If a stock or the market makes us feel fear, we judge it to be high risk. If it makes us feel excitement, we judge it to be low risk. In a crash, the ambient emotional state is pure fear. Every financial decision is filtered through this lens of terror. This is why people who can calmly articulate a long-term strategy during normal times will suddenly abandon it in a panic. Their analytical brain has been completely overridden by their emotional brain. Buffett's great psychological skill is his ability to build a fortress around his mind that is impervious to these forces. He famously says he tries to be fearful when others are greedy, and greedy only when others are fearful. This is not just a clever aphorism. It is a description of his emotional state. He cultivates a sense of fear and skepticism during bull markets, when the availability cascade is all about endless prosperity. And he cultivates a sense of detached analytical greed during bear markets, when the affect heuristic is screaming fear at everyone else. He does this by deliberately insulating himself from the noise. He doesn't watch financial television. He doesn't listen to market forecasts. He reads annual reports, industry journals, and books. He focuses on the signal of business value, not the noise of market sentiment. To develop this kind of courage requires more than just willpower. It requires a pre-committed strategy, a tool to force rational behavior when your instincts are betraying you. This tool can be called the anti-news investment checklist. It is a blueprint for acting rationally during a market crash. Step 1. For every hour you spend consuming news about the market panic, you must force yourself to spend 1 hour reading the primary source documents of the companies you own or want to own. That means opening up the 10K, the annual report. Look at the balance sheet. How much debt do they have? Look at the cash flow statement. Are they still generating cash? This simple rule creates a balance. It forces you to counteract the emotional, narrative-based information from the media with cold, hard, factual data from the business itself. Step 2. You must create your shopping list during times of market calm. This is a list of 10 to 15 wonderful businesses that you would love to own, along with a buy price for each, a price that would represent a significant margin of safety. You do this research and set these prices when you are calm, rational, and objective. A market crash is not the time to be starting your research. It's the time to be executing from your pre-prepared list. The crash is simply the sale you've been waiting for. When it happens, you don't have to think. You just have to look at your list and see if any of your target companies are hitting your predetermined buy prices. Step 3. Automate your greed. When your shopping list is complete, go to your brokerage account and enter good till canceled limit orders for your target companies at your target prices. This is a profoundly powerful psychological trick. It automates the act of being greedy at the point of maximum fear. When the crash happens and the stock plummets, your order will trigger automatically. You don't have to summon the courage to click the buy button while the world feels like it's ending. Your past rational self has already made the decision for your future emotional self. This systematic approach is a practical application of behavioral finance designed to overcome panic and enable opportunistic action. The path of the 99% during a crash is a tragedy of self-inflicted wounds. Their actions are a perfect mirror image of what is required for success. First, they are paralyzed by the fear of catching a falling knife. They see a stock they like dropping from 100 to 90 to 80, and they think, "I'll wait for it to bottom out." They are trying to time the exact point of inflection. But bottoms are only ever visible in hindsight. The market turns when sentiment is still terrible. By waiting for the bottom, they inevitably wait too long and miss the biggest part of the recovery. As the losses mount, their loss aversion reaches a fever pitch. The pain becomes unbearable. This leads to the ultimate act of wealth destruction, selling at the bottom. They capitulate. They sell everything to protect what's left, crystallizing their temporary, paper losses into permanent, real-world losses of capital. Their mantra then becomes, "I'll get back into the market when things are more certain." But certainty is the enemy of high returns. Certainty and low prices are mutually exclusive. By the time the economy is clearly recovering and the headlines are positive again, the market has already soared from its lows. They end up buying back in at prices much higher than where they sold. They have perfectly executed the formula for financial failure: sell low and buy high. It is a cycle driven by the most basic and powerful human emotions, and it is why the vast majority of retail investors dramatically underperform the market over the long term. The direct financial connection here is the opportunity to acquire long-term earning power at a massive discount. When you buy a stock, you are not buying a piece of paper or a blip on a screen. You are buying a fractional ownership stake in a business and, with it, a claim on its future stream of earnings and cash flows. A market crash is a rare event where the market allows you to buy that future stream of cash for an incredibly low price. Let's make this tangible. Consider a high-quality business that reliably earns $10 per share. In a normal market, investors might be willing to pay 15 times those earnings for the stock, giving it a price of $150. Your earnings yield, the earnings per share divided by the price per share, is 10 divided by 150, or 6.7%. This is like buying a bond that pays you a 6.7% coupon. Now, a market crash occurs. Panic sets in. The price of the stock is cut in half, to $75 per share. The business is still earning its $10 per share. Perhaps it dips for a year during a recession, but its long-term power is intact. At $75, you are now paying only 7.5 times its earnings. Your earnings yield has skyrocketed. It is now 10 divided by 75, which is 13.3%. You are now getting double the earning power for every single dollar you invest. Your future returns have been dramatically amplified, simply because you had the courage to act when the price was low. This is the ultimate secret of long-term investing and buying low. It's not about timing the market. It's about valuing the business and recognizing when Mr. Market is offering you a once-in-a-decade bargain on future cash flows. This is a concept that is as vital for entrepreneurs evaluating asset purchases as it is for the retail investor building their portfolio. We have now arrived at the fifth and final pillar, a principle that may seem counterintuitive in our fast-paced world, but is perhaps the most powerful wealth creator of all, the power of inaction. After all the hard work of redefining risk, valuing businesses, demanding a margin of safety, and acting with courage during panics, the final step is often the most difficult: to do nothing. It is the art of patient compounding, of letting your wonderful businesses do the heavy lifting for you, year after year, decade after decade. The vast majority of long-term returns do not come from clever trading. They come from owning great enterprises and allowing the magic of compounding to work, uninterrupted by emotion or activity. The quintessential story of this principle is Buffett's investment in the Coca-Cola Company. In 1988, following the market crash of October 1987, Buffett saw an opportunity. Coca-Cola was one of the world's most iconic brands, a phenomenal business with global reach and pricing power. Yet the stock was languishing, caught in the post-crash pessimism. Over several months, he invested over $1 billion, acquiring a significant stake in the company for Berkshire Hathaway. This purchase, made with his usual attention to value and margin of safety, was a brilliant move. But the true genius of the Coca-Cola investment was not in the buying, it was in the holding. For the next 30-plus years, Buffett simply sat. He did almost nothing. He held his Coca-Cola stock through the recession of the early 1990s. He held it through the dot-com bubble, when Wall Street was deriding him as a dinosaur for owning old economy stocks. He held it through the gut-wrenching collapse of the dot-com bust. He held it through the 2008 financial crisis, when the stock, like everything else, took a major hit. He held it through countless economic cycles, geopolitical crises, and changes in consumer tastes. Why? Because he understood that he was not an owner of a stock. He was a part owner of a business, and the business of Coca-Cola was performing magnificently. It was expanding around the world, raising its prices, buying back its own stock, and gushing ever-increasing amounts of cash, which it returned to shareholders in the form of dividends. Buffett's job was not to guess the short-term direction of the stock price. His job was to periodically check if the fundamental business and its competitive moat were still intact. As long as the answer was yes, the most profitable course of action was inaction. The result has been one of the greatest investments in history. That initial $1 billion stake has grown in value by more than 20-fold, but even more importantly, it has paid Berkshire Hathaway tens of billions of dollars in dividends over the decades. The annual dividend Berkshire now receives from Coca-Cola is more than half of its original purchase price. This is the power of uninterrupted compounding. It's a snowball rolling down a very long hill. The key is to find a good, wet snow, a great business, and then not get in the way of the snowball as it picks up mass and momentum. The psychological forces that make this simple act of holding so difficult are the action bias and the ego. Humans are wired for action. When faced with a problem or uncertainty, our instinct is to do something. Sitting still and doing nothing feels like negligence, like an abdication of responsibility. In investing, a volatile portfolio is perceived as a problem. Therefore, the action bias screams at us to fix it, sell a loser, buy a winner, rebalance, change something. To simply sit on your hands while your portfolio is dropping feels deeply unnatural. This bias is magnified by the ego. Active trading feeds our sense of control and our desire to prove we are smart. We want to be the clever strategist who can outwit the market, who can sell at the top and buy at the bottom. Patiently holding a stock for 30 years doesn't offer many opportunities for self-congratulation along the way. It's boring. It doesn't make for exciting cocktail party conversation. Warren Buffett's approach is the ultimate act of checking one's ego at the door. He recognizes that his great advantage is not in being able to predict the market, but in being able to identify and partner with great businesses. Once that partnership is made, his ego takes a back seat. He lets the brilliant managers and powerful brands of the companies he owns do the work. He understands that every decision to sell is a new decision that has to be right, and it also incurs taxes and transaction costs. His default action is inaction, and the hurdle to overcome that default is incredibly high. To cultivate this power of inaction, you need a mental model that reframes your relationship with your investments. The most effective is the business owner mindset. This is a blueprint for shifting your identity from stock player to capital allocator. Step 1. Eradicate the phrase "my stocks" from your vocabulary. Replace it with "my businesses." Stop thinking of yourself as someone who trades ticker symbols. Start thinking of yourself as a silent partner in a collection of real-world enterprises. You are part owner of a company that makes smartphones, a company that sells coffee, and a company that insures cars. This semantic shift has a profound psychological impact. Step 2. For each of your businesses, ask yourself this question. If this were a private family business that I owned outright and there was no daily stock quote, would I be thinking of selling it today based on the current news? Imagine you own the best local restaurant in your town. It's consistently profitable. Would you sell it because of a forecast for a mild recession next year? Would you sell it because a new restaurant opened a few blocks away? Probably not. You would focus on the long-term health and operation of your business. You must apply this exact same long-term business-focused logic to your public company holdings. The existence of a liquid stock market is a convenience, not a command to act. Step 3. Before you are allowed to sell a single share of any of your businesses, you must open a journal and write down the business reason for the sale. The stock price went down is not a business reason. The stock price went up is not a business reason. A valid business reason would be, the company's competitive advantage has eroded because of a new technology, or the management team has proven to be untrustworthy and is misallocating capital, or I have found a different business that is significantly better and is selling for a much cheaper price. This simple rule forces you to separate your selling decisions from the emotional whims of Mr. Market and anchor them in the rational reality of business fundamentals. The antithesis to this patient, business owner mindset is the path of the 99% hyperactive trading and performance chasing. The average investor is a whirlwind of counterproductive activity. Enabled by zero-commission trading apps, they check their portfolios multiple times a day. They are constantly tinkering, selling a stock that's been flat to buy the hot new thing that's been soaring. This is called performance chasing, the assumption that recent past performance will continue into the future. They sell last year's laggards and buy last year's winners, a strategy that is statistically proven to underperform because it systematically forces you to buy high and sell low. This constant churning does immense damage to long-term returns. First, it racks up taxes. Every time you sell a winning stock held for more than a year, you owe capital gains taxes to the government. This is a direct, guaranteed reduction of your principal, a leakage from your compounding engine. Second, even with zero commissions, there is still a bid-ask spread on every trade, a small but real transaction cost that adds up over time. But the greatest damage is strategic. By constantly jumping from stock to stock, the hyperactive trader ensures that they will never benefit from the long, multi-year 10-bagger returns that are the true source of wealth creation. They are playing the market's game of short-term sentiment, not their own game of long-term business ownership. They are a leaf in the wind, not the captain of their own ship. The direct financial connection of the power of inaction is the preservation of the uninterrupted compounding engine. The math of compounding is simple, but its results are almost beyond belief. Let's run the numbers. An investment of $10,000 that compounds at an annual rate of 10% for 40 years will grow to $452,592. The majority of that growth comes in the later years. After the first 20 years, the portfolio is worth $67,000. In the final 20 years, it grows by an additional $385,000. This is the magic of compounding. The returns start earning returns on themselves, creating an exponential explosion of wealth. Now consider an investor who gets scared by volatility. They hold the investment, but during two severe bear markets over that 40-year period, they panic and sell, staying out of the market for a year each time before getting back in. They miss the initial, sharp recovery phase. This seemingly small act of trying to manage risk by avoiding the volatility could easily cut their average annual return from 10% to, say, 8%. What does that do to the final number? At an 8% return, their $10,000 grows to only $217,000 after 40 years. Their attempt to sidestep the short-term pain of volatility cost them over $235,000, more than half of their potential fortune. Volatility is the price of admission to the theater of long-term compounding. Trying to sneak in without paying the price by jumping in and out of the market ensures that you will miss the best parts of the show. Patient, uninterrupted ownership of great businesses is the only way to capture the full, explosive power of this mathematical miracle. It is the final and most crucial component of a true wealth-building mindset. You have just spent this time fundamentally rewiring the operating system of your financial mind. You have acquired a new language, a new framework for seeing the world of money and business not as a chaotic casino, but as a logical, navigable landscape. You have rejected Wall Street's self-serving definition of risk and replaced it with a more powerful one. You have learned to see the manic-depressive Mr. Market not as a source of wisdom, but as a source of opportunity. You have armed yourself with a margin of safety, a fortress of humility that protects you from the most dangerous enemy of all, yourself. You have found the courage to act when others are paralyzed by fear, and the wisdom to do nothing when the sirens of action are calling. This is more than just a set of tips. It is a complete philosophy for turning volatility from a threat into an advantage. But understand this. What you have just mastered is a single foundational pillar in the grand architecture of the Buffett-monger mind. It is the shield. It is the defensive bedrock that makes all else possible. But how does this shield integrate with the spear? How does this profound understanding of risk and price inform the active process of finding those truly wonderful businesses in the first place? How do you analyze a balance sheet to find hidden strengths or an income statement to identify a durable competitive moat? How do you assess the quality of a management team from the cold print of an annual report? The redefinition of risk is the what not to do. But what about the what to do? The video that YouTube is now recommending for you, the one on your screen, is not a random suggestion. The algorithm, in its own way, understands the path you are on. It has identified the next logical piece of the map, the next step in your intellectual ascent. That video contains the missing link. It holds the key that connects your new understanding of risk to the practical, day-to-day work of investment analysis. It is the bridge between philosophy and execution. Most people will stop here. They will be content with this one powerful piece of the puzzle, and their journey will end. But you are not most people. You are an architect, and an architect does not stop when the foundation is laid. The decision to click is not about watching another video. It is a declaration that you are serious. It is a commitment to completing the blueprint, to building the entire intellectual arsenal required for true financial sovereignty. Continue your ascent. Complete the model. The next piece of the map is waiting.